Hawkish messages from the Federal Reserve are colliding with an AI-driven capex boom and rapidly shifting energy risks, forcing a rethink of risk and reward across every major asset class. Welcome to vTalkInsight, Allocator's Lens Daily for June 18, 2026. Let's start with equities, where that clash between policy and growth is most visible in prices and volatility. In equities, the core tension is clear. Powerful AI-driven growth and resilient earnings are now bumping up against a more hawkish Federal Reserve and rising yields. The Fed held rates at 3.5 to 3.75%, but the latest projections show many officials leaning toward at least one hike, and that surprise pushed two-year yields sharply higher and drove broad declines in the S&P and Russell indices, with equity volatility moving back toward the high teens. Under the surface, the AI investment cycle remains a major support for equity risk premia. There is a historic capital expenditure boom in data centers and compute infrastructure, which is boosting demand for materials and labor and helping drive solid growth and robust consumer spending, even as it keeps inflation sticky and forces the Fed to sound tougher on price stability. Importantly, the AI story is evolving from pure infrastructure spending to real-world adoption. Enterprise deployment is accelerating, with thousands of use cases at scale, and companies from hardware providers to consumer brands are embedding AI into workflows, marketing, and research, suggesting the earnings contribution could broaden beyond the original picks and shovels trade. That said, some of the brightest AI beneficiaries now show signs of exuberance. Earnings revision breadth in semiconductors has reached levels that historically precede sizable pullbacks, and governance questions are rising as names with limited free float and concentrated control, such as SpaceX, become major index constituents, increasing concentration and potentially raising risk for passive equity holders. On top of valuations, the supply picture is shifting against equities. Net equity issuance is expected to swing by roughly $1.5 trillion over 2 years as new listings and follow-on deals reverse decades of buybacks, while liquidity is already being absorbed by heavy equity and bond issuance and real economy capex, raising the odds of volatility spikes and corrections that could easily reach double digits in crowded segments like tech. Regionally, value is increasingly found at the sector level rather than in whole indices. European banks and select cyclicals are becoming more interesting as energy risks ease, even as the autos complex, led by BMW's severe China-related downgrade, drags the region and highlights how geopolitical and competitive shocks can batter individual sectors even when the stock sits near record highs. For allocators, the key equity watch points now are Fed rhetoric into September, the pace and quality of AI capex, the market's capacity to digest record issuance, and whether earnings leadership broadens beyond the current tech-heavy cohort, because those factors will heavily influence how much pressure higher rates ultimately put on equity multiples. Turning to rates, the message is a hawkish hold with growing uncertainty about the path. The FOMC kept the policy range unchanged at 3.5 to 3.75%, yet the latest projections show 9 members now penciling in a hike this year, and markets have responded with a notable repricing, taking the 10-year yield from around 3.9 to 4.7% and flattening the curve as front-end yields move up the most. At the same time, the Fed is rethinking how it operates. Under new leadership, it is launching task forces on balance sheet policy, data methodology, AI's impact on productivity, and inflation frameworks, while stepping away from detailed forward guidance, so that financial prices provide more independent signals rather than simply echoing central bank projections. The inflation backdrop is nuanced. Disinflation forces, such as cheaper oil as the Strait of Hormuz partly reopens, Chinese manufacturing overcapacity, and some AI-driven efficiencies are pulling prices down, but structural constraint from tariffs, limited labor force growth, and the very same AI capex boom are keeping underlying inflation above target, even as the Fed's baseline still assumes a soft landing with growth a little above 2% and core inflation gradually edging back toward 2% over the next couple of years. Against that backdrop, some investors remain hesitant to add duration, seeing inflation as persistent enough that current yields do not yet fully compensate for policy and term risk. For allocators, the key is that higher for longer is now paired with greater communication uncertainty, so rate volatility could stay elevated. Upcoming data on services inflation, wage trends as energy costs normalize, and evidence on whether AI genuinely boosts productivity will be critical to whether the Fed follows through with additional tightening or extends the pause, with obvious knock-on effects for credit and equities. In credit, valuations look full at the index level even as opportunities emerge beneath the surface. Spreads sit in their richest decile of the past quarter century, and in investment grade, spreads have roughly doubled over the last year and a half, reflecting a repricing of risk even though levels remain tight by historical standards, which makes broad, passive credit exposure less compelling on a simple carry basis. The AI build-out is a central driver of today's credit story. Large infrastructure and technology names are issuing aggressively across formats, from plain vanilla corporate bonds to more complex structures, and while demand has been strong, as seen in recent high-profile offerings, many large investors view unsecured debt of major tech issuers as expensive and see better value in collateralized or structured exposures that offer wider spreads for similar underlying risk. Private credit adds another layer of complexity. It still offers useful diversification, but some vintages are now under pressure because leverage incentives and promises of near-instant liquidity to retail investors clash with the illiquid nature of the assets, a tension that could intensify if higher policy rates and deteriorating secondary market liquidity start to bite. Overall, the combination of rich index spreads, heavy issuance tied to AI and infrastructure, and a gradually tightening liquidity backdrop points to a market where broad beta exposure is less attractive than careful security selection. Dispersion between sectors and structures is widening, so defaults, recovery values, and funding access for highly levered or AI-dependent borrowers will be important signals for how much additional risk premium credit may demand relative to rates. In foreign exchange, the dollar is back on the front foot. The more hawkish tone from the Fed, combined with expectations that the U.S. economy will continue to outperform peers thanks in part to the AI boom, has encouraged investors to rebuild long dollar positions, with many looking for euro-dollar to drift lower and dollar-yen to stay biased towards strength unless global risk sentiment improves markedly. Sterling offers a different mix of forces. Inflation in the United Kingdom held at 2.8% year-on-year instead of rising to 3%. Easing immediate pressure on the Bank of England to tighten aggressively, yet the pound still benefits from relatively high carry and lower direct exposure to commodity price swings, even as upcoming borrowing data and political volatility keep fiscal credibility firmly in focus. More broadly, currency markets remain the release valve for diverging policy paths and growth trajectories. If the proposed U.S.-Iran ceasefire holds and energy prices stay contained, some of the dollar's safe haven bid could fade, but as long as U.S. yields remain meaningfully above those in Europe and Japan, rate differentials will continue to anchor dollar support, making incoming data and central bank communication on both sides of the Atlantic crucial for FX positioning. Finally, in commodities, oil is at the center of the story. Crude prices have dropped rapidly back toward pre-crisis levels, with Brent sliding below $80 as markets respond to a draft memorandum between the United States and Iran that envisages reopening the Strait of Hormuz, lifting some sanctions, and unlocking substantial development financing. While major forecasters now project West Texas Intermediate averaging around $75 this year and easing further next year. Yet the fundamental and geopolitical picture is less straightforward than recent price action suggests. The strait remains only partially reopened. Any normalization in shipping flows is likely to be gradual, and the ceasefire framework is viewed as fragile, with ambiguous language on nuclear activities, vocal political opposition, and repeated signals from U.S. officials that military options remain on the table if compliance falters, all of which preserve a meaningful upside tail for oil. At the same time, structural shifts are underway that could reshape the medium-term energy premium. Europe is pushing for greater energy autonomy and technological sovereignty. Multilateral lenders are scaling up investments tied to those goals, and Gulf producers such as the UAE and Saudi Arabia are investing heavily in alternative export routes that reduce reliance on the strait. So, if a durable ceasefire emerges, lower and more stable energy prices could reinforce global disinflation and give central banks more room for patience, whereas any breakdown would quickly feed back into inflation. expectations, rate path debates, and risk appetite across assets. Bringing this together, the cross-asset picture now hinges on how far a more hawkish but less predictable Fed has to go to re-anchor inflation, and how that interacts with an AI investment cycle that is simultaneously lifting growth and keeping price pressures elevated. Equities are caught between powerful AI-driven earnings and heavier issuance. Rates are embedding a higher for longer regime with more communication risk. Credit spreads look tight, but increasingly dispersed. The dollar is leaning on both yield and growth advantages, and oil is testing how much geopolitical optimism is already in the price. For allocators, the key watch points are upcoming inflation and wage data, the Fed's tone into September, the market's ability to absorb ongoing equity and credit supply, the durability of dollar strength, and the evolution of the Iran ceasefire into either a durable peace or another episode of energy volatility. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.